Hello and welcome everyone to another Friday afternoon webinar to update you on what's going on in the markets. So it's good to have you here today, and it's certainly a beautiful day outside, and so we appreciate you taking a few minutes. And the good thing is we get to wrap up a month and we get to look forward to the month of May. So we wanted to make sure that we cover kind of what we've seen happen over the previous month and a half, as well as talk about kind of what's foreseen moving forward. Before we do that, though, I want to encourage you from a question perspective. You can submit questions right there on the webinar, so I'm going to encourage you to do that. If you do have questions, we try to get to them if we have time. We certainly value everybody's time and try to keep it fairly short. And also, we want to quiz you a little bit and do a quiz. So let's look at a couple questions here. So the first question is, so please answer, from 1928 until 1945, we had 12 20% or greater downturns. In the 75 years since the World War II ended, there have been how many? Would that be 13, 6, or 18? Give me your question. 13, 6, or 18? Answer your questions. Questions are coming in. So think about it. That's a long time frame. What has happened? And you can answer them right on the screen there. And then in the last 9 decades, we had a bear market for how many years? So we had a bear market for how many years? In the last 9 decades, 90 years, we've had bear markets for how many years? 21, 17, or 25. So if you're calling in on the phone, sorry, you're not going to be able to see these. And if you're joining us on Facebook, thank you for that. So the answer to the first question is actually 13. So 30% of you got that correct. 70% of you said 6. So I was hoping it would be 18. Nobody said 18, but the correct answer is 13. And then the second question, in the last 9 decades, we've had a bear market for how many years? And the correct answer is 21. So 41% of you, 40% of you said 21, and 50% of you said 17. So just some interesting facts. We want to direct you afterwards. We're going to put a couple new pieces on the website. It'll be in the Volatility Resource Center. We have this 2-page kind of synopsis on the retirement account relief and what happened with the legislation that was signed a few weeks ago. It's got a lot of great information on there. So that should be up sometime this weekend on the website. So I would go in either later this weekend or first of the week. These are a couple brand new pieces that we are making available. The second thing is just some important kind of interesting facts about the end of a bull market, and talks through just 10 important bullet points, and actually got a couple of those questions from there. So again, I would encourage you to continue to visit the website, particularly in that area under the Resource Center. So as we've had now for many weeks, Beth Foley, Bill Davis, and Matt Aurenz has joined remotely. And our plan in the firm right now is to continue to work remotely through the month of May. And then we will determine from there kind of what makes the most sense for our clients and for our team members and everyone involved. So let's bring up our agenda. So we've got really 3 topics we want to talk about today. It's confusing. April felt good, but, and then charitable giving. So it's confusing. Are you confused? What's happening? Many are. We've heard many clients say, and in conversations we had, doesn't make a lot of sense. You know, here we are in record unemployment numbers. We're in a recession. yet the markets have acted the way they are, and we had a really good April. So who wants to start us out on the panel today?
Well, my personal frustration is the media. I think the best thing I liked was somebody said, let's turn off the media for 30 days and see what that quarantine does to the to our psyche. But it's we're not any closer to truly opening up the economy without more testing. And whatever your media source is, it's confusing because it's confusing to me. And so I'm sure that the people on the call experience the same frustration as I do. Depending on the network you might tune in at any given time, you're going to hear 100% optimism or 100% pessimism. And I'd like to have something that maybe it's down the middle that has some factual data attached to it.
And Bill, I think just to add, I think about May, and of course, a beautiful day out here today, and hopefully that will help. So people will shut off the TVs, right, and the media, and get outside and enjoy some outside weather. But that's a great thought. What would happen if they shut it off for 30 days? So Matt, Beth, what are your thoughts on this?
Well, to the point that Bill just made about the media and confusing and different information coming through, Matt shared with us an interesting article this morning, and one of the pieces in there talked about the media and the presentation of ideas and what kind of hits the top of it. And there was this just a small graph that said that in March, as far as media topics, the trending topics as far as going up, which have now fallen off, were recession and infection. And then, although not too much has happened with all of that, other than the idea that we're probably deep into a recession at this point in time, as April came along, the top media topics were vaccines and therapeutics. So, it is changing, and we all know that there are just a lot of unknowns right now. We don't know, there's promising word about vaccines, there's promising word about therapeutics, but we don't know when that's going to be available. We don't know how it's going to be available, how effective it's going to be. There's so many things that we don't know, and it's confusing because we want to know those things. And we want answers, and we're seeking out answers, but I think that there's a matter of patience as this information that we want develops and evolves over time. It's just going to take some time to get to those answers. So I am in full agreement, and I've taken it on myself already. Turn off the media, and to the extent that you can, while still staying somewhat in tune, but turn it off, and just take a break from it may help with some of the confusion.
Yeah.
My opinion.
Go ahead. Well, I was just going to say that, yeah, it certainly is. I mean, both of you make really good points that it doesn't tend to add up. And we'll talk a little bit about that recession in markets, and they don't necessarily tie together. So April felt really good. In fact, Matt, you were running off some stats with us earlier, being our analyst on the team and director of investment management. So it felt really good. In fact, it had some records there on the upside, but we also know, it's not over.
Yeah. April was interesting, that's for sure. I think numbers I saw this morning was some of the best April's ever performed in the Dow, or at least since the Great Depression era. NASDAQ, 20, 30 years, S&P, same thing. So recovery obviously was good, injected primarily due to the Fed and government pumping trillions of dollars into the economy, and I think some of it still stems from earnings coming out that don't look as bad as they initially indicated, due to you had 2.5 months where the market wasn't shut down in the first quarter, so that definitely helped. But when you kind of take a look at volume, which we talked a little bit about this morning, volume, I think there's a slide on that, or maybe I'm jumping.
Yeah, let's pull that up and talk about that specifically.
volume basically, it had, for us right now, is just this big indicator of what's going on, and relatively steady for the last 12 months until obviously March and April. And you can see when volume is increasing rapidly, volume is important for a couple of things. One, it helps, with liquidity. If there's no volume in a stock, it could be difficult for somebody to sell it because there's no buyer. But the bid and ask are traditionally relatively close to each other, so you're not getting massive inefficiencies in pricing, which also help. But it's kind of confirming, trend and direction too. And so there's really like 4 ways that you could look at it. Price and volume are going up, price volume going down, or price up, volume down, or that inverse relationship. And all of those really generate some type of different fundamental and psychological trending of what that stock is going to do. And so when you see obviously the price drop and prices drop and volume drop, or excuse me, prices drop and volume increase, there's really just a fundamental shift in stocks, and there's a psychological shift. And so that's obviously what happened in March. When we see the opposite come, in April, we see basically the same fundamental, and fundamentally nothing changed. Psychologically, everything changed. And so that's driving the price up. So when you have volume down and price up, it's kind of a weird anomaly that you see that says, well, everybody's feeling euphoric, but fundamentally there's nothing there to support why that trending of price is going up. And so, that's why as we continue to have these discussions, people say, well, it seems like everything's going up. Are we missing the boat on, opportunity and those types of things? And really we're saying maybe, but if you're not seeing volume increase while that trending is going up as rapid as it did, not long-term up, the steady eddy, but when you see that rapid V-shaped recovery without fundamentals to support it, because volume is down, we're saying, maybe not. We're probably going to test either some down again, or it's being supported by something. And that, again, going back to our belief that it's being supported right now by the Fed in Congress. So, again, we'll probably see what happens in this next couple of months, but that's why I think we're just being cautiously optimistic about where this is going, and also why volume is important.
Yeah. Thanks, Matt.
When you look at that and see that there's not a lot of volume, even though prices are up, is that a little bit of indication that people are sitting on the sidelines and not doing a lot of trading as well, which would indicate, a lack of confidence in things, or people just kind of being patient with this?
I think so. And I think it's also, it creates like an indecision for people to buy, right? They're saying, well, do I really want to buy? And I think, when you look at the psychological side, people are saying, should I buy? Because I don't want to miss out on the return. But they're not feeling comfortable with the purchase, right? It's like,
Right.
Well, maybe that car will go on sale next month, but I better buy it now because the price looks pretty decent. And I think that's kind of what's going on. And just, again, when you get back to the media that you were just talking about, that talks about, hey, the economy is just going to open the doors again, everything will be fine. They're kind of shifting the narrative. Now people are saying, well, maybe we did miss the boat. There's just this, I don't know. My opinion on stuff, on all this stuff, changes based on who I talk to, it seems like, because, everybody has a valid point, and it's really just sifting through that to figure that out. But I think this chart just helps me see a little bit more of, there's some inefficiencies here. Psychological looks good, fundamentals don't. There's going to be some mispricing in the market.
Yeah, so kind of making that towards unemployment discussion. Obviously, we've hit, there's record numbers, right, of unemployment, and we're continuing to see, we had 3.4 million yesterday. And one of the things that, as analysts are starting to dig into this, they're saying that, the initial unemployment surges were of businesses that certainly were shut down. Couldn't do business, retail, restaurants, a lot of those businesses absolutely couldn't work remotely. And now what we're starting to see is potentially cutbacks in large solid organizations I know, Beth, you mentioned up there in the greater Detroit, right? A couple really large healthcare organizations.
Yeah, so anybody in this area clearly is going to be aware of the Henry Ford Health System and the Beaumont Health System. And Henry Ford Health System has recently announced layoffs of in excess of 2,800 people. And this is across the board of, from their IT groups, not just in the hospitals and the health systems. I think that I heard Beaumont is up to 4,000 people. It reminds me of maybe going back to the early 2000s and the recession then. A client gave me this term of corporate anorexia. So things are tough enough that they're starting to cut into the muscle of, some people that you would never anticipate being furloughed or losing their jobs. I have a lovely client who has a senior position, a middle management senior position at a local advertising firm that does work for national campaigns and so forth. Would never, ever have expected. I mean, she's seen her way through all kinds of pullbacks and recessions and so forth. And she is furloughed as of today, right? So a little bit of corporate anorexia digging into this.
Yeah, so I think that kind of what we're seeing there is that's going to happen. Many organizations now are either furloughs, layoffs, cutbacks, taking a reduced in income. And then Bill, you've been kind of tracking some companies. We talked about this yesterday as well when we were chatting as a team. Whirlpool looking for 500 million in a reduction. So. And the announcements keep going now, don't they?
Yeah, they keep building. I just saw a number today from DWD in Indiana, paid 1.39 million claims in April. Last year, they paid 194,000.
Yeah.
It's just crazy. And yes, the Whirlpool announcement yesterday of $500,000 in cutbacks, one of our largest health systems, down across the board. They're trying to preserve jobs, so they're going to cut back on wages and see how that works for a period of time, because so many services have been cut off during the pandemic that voluntary services or even needed services were cut back. So hopefully they're getting back to those services now.
Yeah, I also heard another analysis that was interesting in the sense of states are starting to open up, slowly, and a lot of states have restaurants at 25% capacity and things of that nature. And they said a lot of those restaurants probably will just close because it doesn't make sense to bring people back for 25% inside the store. So, again, it's not over. We said the last couple calls that the next quarter results is going to be not good. We're not trying to paint a grim picture. We don't want folks making decisions based on emotion, but it's just the facts. It's just the other thing that we've seen numbers, which doesn't usually happen, is a lot of most public companies give you projections for the next quarter, and a lot of those have pulled out of that. So they're not even giving projections and where they'll fall as it relates to that. So sometimes there is that disconnect, and here we have it. Matt said, record April, which was good, because if you'd have made decisions in March, they could have been really costly. But we still think there'll be volatility along the way and things of that nature. So, any other comments about that?
Yeah, I think just, something that I'd mentioned to the group earlier, this quote from that article that Matt had, which is, it's with regard to the stock market, kind of a disconnect from where we are from the economy, which, the stock market is not the economy and vice versa, is that the job of the stock market is not to assess the present conditions, but to discount for the future. That's projecting where you want it to go. So, the fact that the market was so high in April, as we saw 30 million people lose their jobs, well, the market isn't looking at what's happening today. It's looking at what's going to happen down the road, which is the same thing as, like the VIX index that we were talking about a couple of weeks ago. It's looking down the road as to what the future might hold. And, you know, the stock market is speculative. It's where do we want to be in the future, not necessarily where we are right now.
You know, we got an interesting question, and I think this holds true prior to all of this going on as well as going forward. But it asked about portfolios. Is Hilltop Portfolios taking dividends in cash instead of buying more shares of mutual funds until the market stabilizes and preserves some capital? So Matt, maybe you should want to comment on that.
I think that one is very individual specific. So, you know, people who are in withdrawal phases, obviously paying the dividends to cash to eliminate having to sell. But if you're not needing the cash, you know, most of the time it seems like we're reinvesting, compounding growth. You're buying in at suppressed share price values, those types of things. I think long term, it mathematically makes much more sense to reinvest dividends than to have them pay to cash. So if you don't need the dividends, I'm always a proponent of reinvesting the dividends.
You know,
keeping the capital build up in cash and then buying in at a later date when things feel good doesn't behoove you. So I'm a proponent of reinvesting.
But a little add on to that, Erik, is, you know, that with our equities primarily being in ETFs, those are not reinvestable. So we do tend to have our equities be paying in cash and our actively managed fixed income going to reinvest.
Yeah, they actually are reinvestable. We just don't traditionally do it.
Yeah, traditionally do it. Yeah. Yeah. And the other thing I saw, and in fact, I was thinking about having it on one of these webinars, maybe next week, is the history of what dividends and how they played out. I think this was based on the S&P. And so the dividends, and we've talked about this story for a while, but the dividends have become a bigger portion of the overall return. This happened after 08-09. And so, you know, I'm sure that will come about. And there's going to be a lot of companies that are going to reduce dividends or potentially eliminate as well. Another question is, what about real estate trusts, REITs?
I think the good news is the majority of the ones that we have are strong. The ones that we've invested in are strong. You know, non-traded REITs in particular, at least the advantage is they can storm a little of the weather, it seems like. Weather a little of the storm, excuse me. Just because they don't have the influx and outflux of cash flow like you would on a traditional stock market. You know, the traded real estate definitely has a much more difficult time. But I think that does beg the question of, as companies begin to work at home more and more, and they're seeing that they're still relatively efficient, are they going to eliminate some real estate? I think that's still something that actually we're going to discuss a little bit more intensely on Monday. But that's something that we're watching to pay attention to. I think it will matter long term, most likely. But there's not enough data yet to support a really strong conviction, in my opinion, one way or another yet.
Yeah, it has to let it shake out a little bit, and probably, definitely highly depending on what those REITs own.
Well, people have leases. So if you're tied into a lease for 10 years, you know, you're going to have to pay a pretty penny to break that lease. So, you know, depending on when that lease expires, you know, you're not just pulling out of some, you know, if you're in a water tower building downtown Chicago, you're not just pulling out with 6 years left on your lease, unless, you know, there's a really strong reason to do so cash flow wise. Mm-hmm. So, you know, I think that's going to help prolong this, and potentially people just say, who knows? You know, I mean, there's a lot of directions that they can go, but I think that's at least one good advantage for stabilizing some of that real estate market.
Yeah, good. Okay, so our third point here was charitable giving. So we just wanted to, as a reminder, a couple highlights there. So Bill, maybe you can just remind folks about how they can help out in all of this.
Well, you know, a lot of our clients have not been able to have charitable deductions ever since the standard deduction doubled. And so under the CARES Act, they allowed now a $300 charitable above the line first page deduction for everybody, no matter what your adjusted gross income is. So we're just thinking that that's a good opportunity for people to, help out. I can tell you here in Marshall County, being a rural area, we're over 20% unemployment right now. And that's causing a lot of people to need relief, both in mortgages, rents, and food. So we just started an initiative to try to put together $400,000 as quickly as possible to help. And I'm happy to say first week we raised $250,000. So as you hear about charitable organizations that you'd like to support during these difficult times, remember that to save that receipt for up to $300, it's an automatic deduction that was given to us in the CARES Act.
And then the qualified charitable distribution. So that's one don't overlook. So I know we're doing that with a lot of clients, but qualified charitable distribution is a way to give to a charity directly from your IRA after the age of 70 and a half. You can give up to $100,000 a year out of an IRA, so it's a pretty high limit. It comes directly off of your taxes, which is a nice thing. And there is no required minimum distribution, which we've been talking to clients about this year because of the CARES Act that came out due to the pandemic. But that really doesn't have anything to do with the qualified charitable distribution. So if you're in a position where maybe not all of your required distribution, maybe some of it, and you want to give to charity, that is the best way because it comes right off the top. And as Bill stated, itemized deductions for many are not available. So we just remind folks in helping out there. And I've heard of several of these, like Bill had mentioned, with these COVID funds that have had some well-funded success, which is awesome. The other thing I want to just make you aware of and kind of look out for next week, we'll talk about it on this webinar, but Hilltop's gonna team up. We want to team up with our clients and friends of the business. And so we're going to have an announcement next week as it relates to charitable giving and how you and us can work together and help a local charity and those that are less fortunate. So let's talk about our takeaways. So long-term optimistic, we're short-term cautious. Who wants to make a comment on that, or a few comments?
Yeah, I mean I would, because I tend to be the pessimist in the room as it relates to this short-term run-up in the market. It just feels to me that it's kind of got us tricked into thinking that the market's going to continue to go up and away, and I fear that we're going to test some lows. I don't think we'll test the 18,000, but I think we could test 20,000 on the Dow, 21,000 on the Dow. So I'm very optimistic for the future, long term, but short term, I think cash is king, and I think we should be just a little bit cautious about jumping into any opportunities just quite yet.
So I think another thing there, Bill, which was a good point, is that it has shown that the Fed is willing to do whatever it needs to do. And, Congress, a little bit more challenging, but, they're talking now about what's next. But with all of that, at some point, you can have the governmental system step in and help, which they absolutely needed to do, without having some sort of price down the road. What are some thoughts there? We don't have any thoughts there. You just think about down the road, right?
I think short term, I encountered a couple of situations this week where short term cautious, long term optimistic. And I agree with that as well. As I said from the beginning, I think there's just still too many unknowns to be able to choose quite a direction yet. And I would caution people about making long-term decisions based on short-term information at this point in time. We still don't quite know how this is all going to play out over the next couple of months. So I'm thinking carefully about decisions, whether it's with regard to portfolios or career decisions or so forth. You know, there's a lot of emotions going on, and emotions are not an investment strategy, right? Panic is not an investment strategy. So I think just being patient and not making some short-term seat of the pants decision that is going to affect you for years to come. Just kind of hold off a little bit and see what else can be done to help us through this.
Yeah, Beth, we don't put panic in our financial plans, do we?
We try not to.
Yeah, that's right.
I think the other thing that, you know, for me, optimistic wise, is the economy. It's not like this economy fell apart on fundamentals. The economy has had a hiccup due to a healthcare crisis, and so I think recovery wise, that's going to help. I think the unemployment numbers, as bad as they are, there are also incentives for employers to lay people off and furlough people. So, you know, some employers are saying, take advantage of that. If I can keep my cash flow stronger, you know, help out my balance sheets, but lay people off, they're collecting an extra $600 a week in their unemployment benefits. You know, they're kind of weighing out the pros and cons of those. There are some incentives for employers to lay people off, and I think they're taking advantage of that. They've delayed that maybe as long as they could. I think the complexity is, you know, people getting unemployment benefits 4 to 5 weeks after they applied for it. You know, those are real struggles that people are going through. But I do have some pretty good hope on once things really are kind of under control. Yeah, there's going to be some fallout long term for a few organizations, but I do think that America's pretty strong. We're going to get back to business.
Yeah, thanks, Matt. We know we don't want to rush to get us through June into July, but we kind of want to get second quarter over with for market wise.
Yeah, and earnings wise, I mean, earnings haven't looked terrible, which is good. You know, I mean, Exxon came out today. They beat earnings per share by 1,200%, and the stock price was down 6%.
Yeah.
You know, but I'm cautious. I'm hopeful. So yeah. I'm gonna play good cop, bad cop with Bill. I think we might test, but I think we're gonna recover.
Yeah.
Really good.
Yeah. All right, and then the last takeaway here: don't confuse the market and the economy. So,
I mean, a record market for the month of April is not an indication that we're on the track to improve this economy. We're going to have probably report the worst GDP in the second quarter since the Great Depression, or maybe ever. I think it'll improve from there in the third quarter and maybe get positive in the GDP in the fourth quarter. But yeah, this short-term market optimism is not what's happening in the economy. So it's going to take us a lot to dig out. I would throw out one thing. I was a little concerned about these people wanting to come back to work on this additional $600 a week that they're receiving, because some of them are making more than when they were working. And Indiana did announce today that if you don't report to work, you will not be paid your unemployment. So they're going to take a pretty firm stand in Indiana. It sounds like, even if they're concerned about their health, I think they'll initially get declined and then investigate them case by case, which you know how long that could take. Yeah. When you paid 1.9 million people in or claims in just 1 month.
Right. Yeah.
Hey, records are made to be broken, Bill.
That's right, Matt. Yeah.
Records are made to be broken. I agree with you, though. I think yeah, there's gonna be some, the market and economy obviously are two different things, so you can't confuse them. But yeah, I won't add anything else there.
What's the old phrase that the market has successfully predicted 9 of the last 5 recessions, right? So they are, disconnected. And Bill, same thing here. I've also heard similar thoughts that if you are called back to work, and you don't go, regardless, if your job is available and you've been called back to work and you don't go, then you could lose your unemployment benefits and so forth. So there's going to be some incentives for people to go back to work, whether they feel safe about that or not. So we'll just have to wait and see how that evolves as the states start loosening the reins a little bit and bringing people back in and opening up businesses again.
I'm just hoping barbershop opens up soon.
Don't
Yeah.
we all?
I have an appointment for May 28th, so that's when I'm saying it's going to be open again. That was a happy day to schedule that appointment.
All right. Well, thank you all. Appreciate the time. And thank you to everyone that joined us today. We really appreciate it. And thank you for those that are clients. We appreciate you. We're here for you. And tune in next week. And we'll give you updates then. We'll be into May and we'll see where things go. Until then, I hope you are healthy and please be safe.